Hello traders and investors, Will back here with another one, coming to you with a Thursday market recap. Hopefully you guys had a very good day in the markets today. And in today's action, well, unfortunately, a bit of an inside trading day. The S&P and the QQQs not doing too much since the Wednesday candle close. Inside trading day, meaning not much action was to be had all across the board. However, we did have a slight downwards bias, and that was in more than just the technology sector for this time around. As you can see right here, most of the market segments were unfortunately down on the day. And we are coming into a period where we're going to get a ton of news releases tomorrow during the Friday session. If you take a look right here, you got a ton of them. You got core PCE and PCE coming in tomorrow morning, hot off the print. 2.9% is the expectation. That will be up versus the 2.8 which we received last month. Now, I'll remind you, CPI and PPI both came in very favorably. And additionally, if you take a look at the Trueflation Index, which measures 15 million different products and services, well, that shows us at under 1%. So the PCE is the Fed's preferred inflation gauge, and kind of the different inflation gauges are all over the place, depending on which ones you look at. However, suffice to say, the trend does remain down, but tomorrow, this one could definitely move the markets. You also get a Q4 GDP print as well. The expectation is to come in at 3%. We know the big one is going to be for Q1, where the expectations are for over 5% GDP growth. So we will see how the markets digest that one as well. And then you have a couple small ones, such as manufacturing PMI and services PMI as well. But there's a bit more than that, of course, with some geopolitical risks as the U.S. mobilizes an entire fleet, a very large armada of both ships and also aircraft off the coast of Iran as tensions continue to build. So in today's video, we're going to make sense of all of it. Speaking about today's video, number one, we're going to go through certain key news elements that I find would be interesting for our analysis. So we'll spend a few minutes doing that. Thereafter, we will get into our technical analysis portion of the video where we run down the S&P, the Qs, and most of your major sectors, see where the money is still rotating into, and which sectors remain very much out of favor for the time being. Thereafter, we will go through our big tech list down here and once again derive, are these companies still good buys? Because we know they haven't done much over the course of the past 3-4 months, other than mostly go down. So we will once again determine whether or not these are good for swing trading opportunities, or if they just may be better suited for the long-term investors seeking to accumulate larger and larger positions into large cap names. Keep in mind, guys, being a large cap investor recently has not been easy. If you take a look here at SCHG, which is your US large cap ETF growth, I mean, it does represent over 196 of the largest companies in the US markets. And as you can see right here, it's just been a downward bias. So it has been a very big stock pickers market right now. Not all sectors are moving the same, and especially the large cap sectors, right? And more focused on those technology sectors too. So we'll speak about that additionally today as we go through the key themes of 2026. And at the very end of the video, once again, we will go through our biggest gainers and losers of the day, of which there were very many. Klarna with their earnings, 27% to the downside, many more as well to the downside. And on the flip side, we got some names that just keep outperforming. John Deere, some of the oil companies, some of the defense contractors as well, leading into the possible conflict with Iran. So we will be briefly going over that biggest gainers and losers list at the end of the video and provide any insights as to where we can find certain trade opportunities or certain swing opportunities to carry us maybe over the next few quarters. So that being said, guys, should be a very fun video. Let's get right into the action. So in terms of the S&P, they were down about 0.25%. The Qs down about 0.38 today. But overall, the broad market was showing signs of weakness. As you can see right here, we still don't have financials. We still don't have healthcare, and we definitely don't have consistent returns in tech. And this is important because they're the three largest components of the market. We know the bottom half of the market has been performing well recently, although consumer staples had a bit of a pullback day today. Industrials, real estate, utilities, energy, and basic materials continue to be the sectors that outperform. The only problem with that is that they're not big enough to make any meaningful moves to the upside on the S&P, right? You really need financials, healthcare, and QQQs to come back into favor, as those sectors have largely done a whole bunch of nothing, right? The QQQs, downward bias in this massive range that we've been in for the past 5 months or so. The XLF, same concept. No lift whatsoever since the month of July. There's been some ups, there's been some downs, but we're right back to the prices that we had last July. And healthcare, I mean, despite them trying, we haven't really done much since the month of November either. So we always need to pay attention to those very critical components of the S&P 500 because once again, they are the biggest. And we know that we're in a market environment right now with a lot of dispersion, meaning the index isn't moving whatsoever. However, you got very wide moves on the names that are generating positive returns this year and the names that are generating significantly negative returns this year. We've talked about this a few times in the past few weeks, but we'll bring it up once again today. So moving on further into our rotation analysis here, you can see that on the one-day relative performance, well, the market is once again favoring the same sectors that have been in favor on a year-to-date basis: energy, utilities, industrials, and basic materials. That's your one day. The 1 week looks largely the same. Utilities, healthcare though, industrials, energy, and real estate, same concept. On the 1 month, same concept as well: energy, industrials, utilities, defensives, materials, and real estate. And if you take a look at your year-to-date performance, it's the same names, right? Energy, materials, industrials, staples, utilities, real estate. And shout out to healthcare. They've been trying, but still not so much, right? Financials, technology, cyclicals, and communication services down. And I'll remind you, communication services is largely just Google, Meta, and Netflix. And those three companies have just been coming down ever since their most recent earnings prints. So please keep that in mind when you're looking for a bit of a sector rotation analysis. Now, moving on to some of the news articles from today. Number one, Trump saying the world has 10 days to see if Iran agrees to a deal or bad things might happen. Now, we know the U.S. has been mobilizing a very large force off the coast of Iran, and of course the tensions are very high right now. Now there is supposed to be a deal on the table. At least that's what we've heard over the past week and a half, in terms of Iranian leadership speaking to the U.S. leadership in terms of brokering some sort of a nuclear deal. Obviously, we know that the U.S. wants Iran to stop any and all nuclear development activities. And we will see if this is just a show of force off the coast of Iran with that big mobilization of armed forces in order to make a deal happen, or we will actually see if they actually go into a strike similar to what happened last June when the U.S. obviously bombed 4 different nuclear sites. So this is definitely going to be one to pay close attention to over the next week or so, over the next 10 to 15 days. Moving on further, another interesting piece of news here out of President Trump today, directing the Secretary of War to process and release the government files related to aliens and extraterrestrial life. Yes, real concepts, guys, right? So we will see if there's more to the story, if aliens and UFOs have always just been a great big conspiracy theory, or if the US government actually has some intel on unidentified aerial phenomena and unidentified flying objects. So this is going to be very fun to pay attention to over the next few months. Moving on a little bit further here, we also have a big decision possibly on the board tomorrow, which would be the Supreme Court ruling in terms of tariffs. Now, this is just a calendar, but what you want to pay attention to is this is usually when the Supreme Court hears arguments for certain cases that they're tackling right now. Those dates are in red, where they hear the arguments, and then they do provide non-argument days / ruling days, which are your green and blue boxes right here. As you can see, for the month of February, tomorrow is one of them on Friday. Then you got another one February 27th, and after that, it falls into the month of March. Usually these are given on the Friday session. So these are dates to pay attention to in terms of that Supreme Court tariff ruling, which is also a certain little element of uncertainty that is plaguing the market right now. And don't worry, I've compiled, and I'll show you once we're done here, I've compiled a list of all the bearish narratives at play right now against the markets, but also the bullish macro tailwinds that we've been talking about that the markets can benefit from leading into 2026 as well. As we know, it's a very polarizing market overall. Now, moving on a little bit further here, you can see that more statistics in terms of the market flow. So retail investors are rushing into software stocks at a record pace. Individual investors buying software stocks for 7 consecutive weeks, the longest streak since at least 2017. Look at this amount of volume being poured in to the software index right now. And as you can see, people are willing to buy the dip. Is it a bit too early for that? I mean, a lot of these companies, we've talked about it recently, have just gotten absolutely destroyed in terms of year-to-date performance. performance. Matter of fact, if you look at their year-to-date performance, you'll see that the worst performers in the S&P are mostly all pure play software stocks or something having to do with a software niche, right? So Intuit down here, 42, AppLovin down 40, despite their very good earnings. Gartner down 36, Workday down 34, Robinhood's down 34, but you can thank crypto for that. Trade Desk, advertising business, but also software down 33%, FactSet another 32. Even the travel companies now not being spared. Expedia, Booking Holdings down 30 and 27% respectively, even though travel has been very strong. The AI narrative is making people question these companies as moats because the argument is, well, with AI tools, will you be able to book directly with the hotels using an AI agent and circumvent the entire Booking.com or potentially Expedia ecosystems, right? And you can see the damage goes on further here. Salesforce down 30, ServiceNow down 29. Need I continue? Probably not, right? All of the worst performers are software, so it's very normal that you have a lot of people trying their hands at buying the dip. The only issue with buying the dip on this is you'll see in a few different slides here, guys, the AI news cycle is not going to stop, right? Arguably, this is the worst that AI is ever going to be. It's the worst that AI agents are ever going to be. So if you are buying the dip in software companies, you have to have that going in terms of an expectation, right? We know the risk to software companies is the seat risk. We know these software companies have tremendous distribution, right? You can vibe code a platform that looks like Salesforce and that somewhat performs like Salesforce, but do you have the distribution? Will anybody buy your products, right? There's a lot of proprietary information that goes into that, a lot of client databases, and a lot of cost of migrating, right, for these big enterprises if they're looking to pivot from a Salesforce to a brand new platform. So all of those risks, the initial AI risks that we just talked about, right, are probably overstated, but the actual true risk is the seat risk, the licensing risk. If AI does replace a lot of white-collar jobs, a lot of these businesses sell licenses per seat, per employee at these companies that are going to use them. Obviously, if AI replaces a lot of white-collar jobs, which has been hinted at by the Microsoft CEO of Azure, well, then possibly these companies are going to be able to, or not going to be able to sell as many licenses. That is the true risk in software. Everything else, in terms of being able to just vibe code a platform that looks like Salesforce or ServiceNow or so many other companies, right? Those are the overplayed part. Moving on a little bit further here, US ETF inflows, in spite of people saying that, well, the US is not the place to be right now, right? Because you know that you got a lot of foreign markets such as the Brazil ETF. Look at EWZ. EWZ is up a lot on a year-to-date basis, already up 20% year-to-date. South Korea as well with their memory companies in the names of Samsung and SK Hynix. That one is up 34% year-to-date. Even the Japanese markets, right, are up tremendously year-to-date, 12%. That's some significant outperformance. And even just emerging markets overall, that trade has been moving very well at about 9.21% year to date. So it leads you to believe that, you know, since the S&P is currently flat and roughly down year to date, maybe the US is not the place to be. Maybe people are just not putting their money in there. Well, that's actually a mistake, right? As a matter of fact, US ETF inflows surged 94% year over year in the first 6 weeks of 2026 to a record $245 billion. And that looks something like that. So money is pouring in to the US markets and especially into various ETFs, but maybe just not the ETFs that we are usually used to talking about, such as large cap growth ETFs or whatnot. There's a lot of very niche ETFs that are getting a lot of love, certain various sectors, right? Like you can think of the defense ETFs and whatnot. Those have been doing very well to start off the year. ITA right here is the iShares product. They're up 13% year to date. So we can go through a number of these very niche ETFs, whether it's these or whether it's some of the energy ETFs or whether it's some of the uranium ETFs or possibly copper or some of the metals ETFs. They've been performing really well. What's not been and even the Russell, some of the small cap ETFs too, right? What's not been performing well is large cap growth, but the equal weighted S&P has been doing really well, which goes to show you that the market breadth is indeed healthy. It's just some of the largest companies in the world are dragging down your market cap weighted ETFs. So keep that in mind. We've spoken about this many times over the course of the past few weeks. Moving on a little bit further, another unusual statistic that we keep bringing up in terms of the dispersion and the variance between your worst performers of the S&P, like it's only February 19th, guys, at the current moment, right? already a month and a half into the year, you got so many companies that are down 20+%, but you also have a huge cohort of companies that are up 15, 20+% only a month and a half into the year. And all of that while the S&P remains very flat. So we've talked about this. This is the concept of dispersion of returns around the mean. And the mean in this case is your S&P. So if you take a look here, 54% of S&P 500 stocks are currently overbought, the highest percentage since June 2025. But at the same time, this is where it gets a little bit weird. 26.8% of names are oversold, the highest since October. Under usual market conditions, these metrics move in opposite directions. And you can see that from the chart right here. Usually, it doesn't happen simultaneously. Either most stocks come into overbought territory as the market is just carrying in a broad market fashion, or most stocks are oversold because we're going through certain types of corrections or whatnot. Very, very rarely will you find these moving in such a beautifully correlated fashion in terms of stocks that are overbought and stocks that are oversold. Just once again goes to show the massive dispersion in the markets right now. And in relation to the S&P. And moving a bit further, I showed this one yesterday, but just to bring it up again, S&P 500 components year-to-date performance through February 17th. The S&P is flat, but only 94 of S&P 500 stocks are up or down less than 5% year-to-date. Most of them, well, not most, but a large portion of them, as we showed from the year-to-date gains versus year-to-date losses, they're up a lot or they're down a lot, right? 117 S&P 500 stocks are up or down more than 20% year to date, guys. This is historic market these are historic market conditions right now. So just keep that in mind. Eventually, we will probably revert to the mean in terms of more correlation of more stocks with the actual S&P, meaning your magnitudes of underperformance versus magnitudes of overperformance will probably consolidate and kind of revert to the S&P 500's mean. Moving on further here, options traders are the most bearish on stocks in more than 12 months after the equity put-call ratio soared to 1.28%. And this is one of the reasons we've talked about it, right? Why the fear and greed index right now is in a feared category. The momentum of the markets right now is not very good because the S&P has been flat. However, you got a few conflicting statistics right here. Stock price strength in terms of net new 52-week highs and lows on the New York Stock Exchange, that's very good. The market is indeed very broad. Stock price breadth as measured by the McClellan Volume Summation Index is also very good, but yet still people are buying protection in record amounts. Put and call options at extreme fear. You saw that from the put to call ratio right here, 1.28. You haven't seen that since the whole tariff situation started last February and March of 2025. The VIX remains at a very high print right now, 20, just showing the volatility underlying the market right now. So keep all of that in mind, guys. It's still a very flat S&P, but this dispersion and the lack of clarity surrounding what the next index move is, some people would say that currently you're in a distribution phase of the market and people are expecting a big leg of downside. But at the end of the day, right, where's the downside going to come from? You got a lot of these companies, especially the big tech companies, that are already down so much year to date. And if you want to see big moves in the index, it's not going to come from just big tech remaining flat and just losing the bottom half of the market. The bottom half of the market doesn't have the amount of weight to pull down the S&P or the Qs another 10, 15%, right? It would have to come from sectors that have already been somewhat out of favor. You'd have to drop financials a whole lot more than they currently are. You'd have to drop big tech a whole lot more than they currently have. Right? So keep all that in mind too, right? Very, very, very strange markets right now. Moving on to a couple AI releases. Google just launched an AI that replaces entire product photo shoots with one image. Studios, photographers, retouchers, marketing teams, thousands of jobs quietly erased. And this is the problem with some of the software companies right now. Every single week or every single month, you're going to get something new. You're going to get a new Gemini model, a new OpenAI model, a new Claude model, right? New AI agent models. And it's going to be this continuous flow of new information that AI is disrupting certain sectors. Now, this product from Google Labs is pretty cool. It's called Pomeli. And basically, you can just take a picture of whatever product you're looking for and create a photo shoot with it. Now, certain people in the comment sections have tested it out and said, well, it's not that good when the software generates when the AI generates, images like this of a product and a photo shoot. Sometimes the actual product may say like face cream, hydrating lotion, stuff like that. And then when it's found in the image, the writing is kind of off, right? So AI still makes a little bit of mistakes there, but still, it just goes to show, right? How many things it can do. As we said earlier in the video, this is the worst that it's ever going to get. Arguably, they'll be able to easily correct that. And we've seen a number of these releases over the past week with the new video platform from ByteDance, which is able to generate movie clips, which a lot of people are, very keen on right now. And then you have this new latest product from Google Labs right there. Moving on a little bit further here. This is a cool application of AI that I found today. This person releasing their own AI tool that they've built, this time for medical purposes. So basically, it's an AI doctor. The future is AI that knows more about your body than any human ever could. I'm sure many of you guys have resorted to Google to ask Google what if you're having symptoms of something, whether you're sick, you have a cold, you have a headache, you ask Google, hey, I'm feeling this way. What could be the possible causes or whatnot? And then you got a bunch of articles and Reddit posts and a bunch of people speculating, right? Well, now this is actually an AI engineered doctor. So it really looks at you can upload your different files with your medical reports, your blood work and things like that. And it's going to learn about you and keep giving you recommendations specifically for yourself and your own anatomy. And it's going to be able to build a profile for you and keep that profile. This is one of the best applications of AI that we've seen recently, right? Rather than all the AI slop that's been coming out recently in terms of either videos or, photos. Not that those are not good, right? But this is something that actually really helps every single person in the world that could possibly use it. So this was really cool. So that kind of sums up all our news releases of the day. And just to kind of just do a big recap as to where we are right now, because I'm sure a lot of people are confused, even though we've talked about it for several weeks on end, right? There's a lot of information. So what I've done here is consolidate it all into one common location. The bearish narratives at play for now in February 2026, arguably most of these bear narratives started taking root end of December. There's been a bit of a pause in large cap growth since the month of October overall, when the markets were very concentrated. We've since recovered, but we know that since the start of January, there's been this very big rotation into the whole value-oriented sector of the market. And why is that? Well, you got a few things going on right now. Obviously, number one is the big old AI paradox. Some people claim AI is the biggest bubble since the early 2000s, but at the same time, every single week, AI is disrupting so many different sectors, sending many stocks, whether large caps or small caps, down and down and down. So what is it? Is it a bubble, or is it the most disruptive technology that the world has ever seen? Or is it both, right? So that's the AI paradox. They're supposed to be mutually exclusive things. It can't both be a bubble, but also be the most disruptive force that the world has ever seen, right? Maybe it's disrupting a lot of jobs in the future, but therein lies the AI paradox. Number two is the Mag 7 CapEx sustainable, right? Leading into questions of how much ROI are these companies going to generate? Obviously, the Mag 7 companies, reasons that a lot of people used to invest in these companies for the past 10 years or so is because they were free cash flow monsters, operating margin monsters. And what would they do with that free cash flow? Well, they would just buy back a ton of shares, which doesn't really help the economy in any single way. It helps their stock price tremendously and helps investors out. But now big tech is reinvesting into their businesses at a pace that we haven't seen for the last 10, 15 years, arguably, for some of these companies, which leads people to believe maybe that the CapEx is not sustainable or that they won't find true ROI. And when these companies are the biggest companies in the market, you kind of need them, right? Which is why the stock market, as measured by the S&P, market-weighted S&P, has been flat. Now you got the new Iran situation, in which global geopolitical tensions are obviously front and center for the markets right now. So it will have to contend with these narratives as well. You also have the Supreme Court tariff decision. We will see what happens with that. JP Morgan put out some statistics recently saying that if the tariffs are striked down, well, the Trump administration still has many different avenues in which they can reinstate the tariffs. However, it may bring some short-term volatility. It's just something else to pay attention to, right? Another bearish narrative that can possibly rock the markets. Then you have the new Fed chair, obviously Mr. Warsh, who was nominated a few weeks ago. It led to, maybe cause and effect is not perfect here, right? I'm not going to say that the nomination of Warsh is the reason that silver and gold crashed, and then we led to a big liquidation cycle in a lot of software companies because of AI releases and a lot of other large cap companies at the same time, right? So maybe a bit of faulty cause and effect, but you do have some underlying concerns that maybe Mr. Warsh is a bit more hawkish than people were anticipating surrounding liquidity. He will cut rates, but he's not a big fan of quantitative easing, right? Which is another liquidity pressure for the markets. You are also operating under record margin levels, and that can cause a lot of unwinds and liquidation cycles, as we've seen over the past few weeks, where a lot of companies have fallen off a cliff, but many other assets that were popular, such as gold, silver, a lot of the metals, they got sheer liquidations upon them, and crypto as well, right? Record margin levels can lead to very volatile swings in the market. So this is something that we're always paying attention to. The jobs data being soft also doesn't help, right? Now we got decent job data recently, but then again, it's still a no hiring, no firing environment. You got private credit concerns. That's largely been in place since the month of October, with the Oracle credit default swaps rates going through the roof, and also certain people questioning whether or not these companies can continuously raise debt overall. And as a result, you got some companies like Blue Owl Capital, right? Their stock price has been down, and they've actually paused redemptions for a retail version of their fund, which is exposed to this private credit landscape. And I mean, even a lot of the private equity companies, right, like KKR and Blackstone and things of that nature, they've just been straight down since the month of October. So please keep that in mind. Just something else to pay attention to. So far, no major cracks there, but there are still some little concerns. That's why it's part of the bearish narrative. And then finally, of course, you got the yen carry trade unwind. Now, this is not new. The yen carry trade has been unwinding arguably slowly but surely over the past, let's call it 9 to 15 months, right? Ever since we got that big scare back here in the liquidation break, August of 2024, the Bank of Japan has raised interest rates a couple times since then, and your yen carry trade has been unwinding ever since. More recently, obviously, was the decision in December. And so you have a perpetual winding down of this yen carry trade, which does put a bit of liquidity pressure on the markets overall. But those are all the short-term bearish narratives at play. Some of them can be longer than others, but you got a whole bunch of macro bullish tailwinds. You got very strong GDP, which is boosted by AI. You do have a rate cutting cycle underway with the end of quantitative tightening, and currently about $40 billion in QE per month. You got low unemployment, 4.3%. That's pretty good. You got low-ish inflation, though sticky between 2.5 to 3%. As I've said, the CPI and the PCE are relatively around there. Trueflation is not, but we know the market does enjoy those headline prints from the Bureau of Labor and Statistics. Then you got very strong earnings from Q4, which we covered, although the price action on a lot of those companies has been abysmal. We cannot say that the earnings were not strong. Earnings from the banks and financials were very strong. Earnings from tech companies were very strong, despite the CapEx kicker, and earnings all across the board, guys. I mean, I can't think of many companies this quarter that really missed the mark on earnings and guided for negative growth when they were supposed to turn positive, other than maybe PayPal, right? Most of all the companies that we've covered so far have reported very strong earnings. And I remember I presented you guys with the FactSet earnings report, right, for Q4 of 2025. So we're going to take a look at FactSet right here in terms of the earnings scorecard, right? Earnings scorecard is still very good for all the companies that have reported so far. Updated February 13th, so fairly recent. 74% of all S&P companies reported so far. And as a result, 74% of them have reported a positive EPS surprise, and 73% of them have reported a positive revenue surprise. That's pretty good. For Q4, the year-over-year earnings growth rate for the S&P is 13.2%, which is very, very, very strong here, guys, right? So we can't complain that earnings were bad. The price action was bad, but the underlying fundamentals were not bad. You do still have the AI megatrend as part of the whole AI paradox, of course, but the AI megatrend is very good for infrastructure and energy. There's a lot of money being poured into the economy to make this AI megatrend happen, and a lot of foreign direct investments from other nations as well, whether they were part of the brokered deals during tariffs, or whether they were just other forms of foreign direct investment into AI, into data centers, into infrastructure, right? Very popular thing, and a lot of money being poured into the country. And lastly, I mean, you do have a lot of fiscal stimulus right now, whether it's the $4 trillion in tax cuts from the big beautiful bill, and also a lot of deregulation policies that we're going to have into this year as well. So the bullish tailwinds here are very good. Like, we cannot say that there's no bullish tailwinds whatsoever, but the bearish narratives at play here since the month of October has had the markets on pause in a light distribution segment right now of the market environment. So keep all that in mind. I summed it up for you guys. Once again, I won't be here for the next few days with you guys, so I figured I should give you guys one last send-off. And then now when we go through a lot of these charts, we will highlight the key themes and narratives that have been very popular. I'll spend most of the rest of the video discussing all of those things, just to give you guys a bit of a refresher, right? Because the last time we talked about those was a few weeks ago. All throughout January, I posted so many videos, such as the 2026 key themes and stocks and sectors to pay attention to. And for the most part, those have all done very, very well. So we will once again get a sense of where we're at in those key themes and whether those themes could still support further investment, despite a lot of them having running so far. So that was a very long introduction to the video, but in times of turbulence like this, I think a lot needs to be said in terms of clarifying and in terms of providing context. So hopefully you guys enjoy when I spend that much time on that. Now, let's move into the technical analysis portion of the video, and we're going to start off with the good old S&P. So S&P inside candle with yesterday's trade, but there is something going on here, right? It's now the third or fourth day that we've closed under the moving averages. Now, we got a little bit of confluence down here. Number one, we're into the support level, which is 685 down to about 678. Pay attention to these liquidation break lows, 676. If you do flush those, that's lower high and a lower low, that would be your first downtrend in a very long time on the S&P, right? And now that we are trading under our 12, our 26, and our 50-day EMA, we haven't spent that long. Most of all the recoveries so far have been V-shaped recoveries. When we snap under the 50-day EMA, the market's usually able to buy those dips fairly rapidly, as we've seen since the month of December. Now, we haven't had a couple days close under the 50 since all the way back here at the bottom of the sell-off in November, or previously in October when things started to get a little bit heated after this China tariff news, right? So definitely a bit of a regime shift in terms of the momentum. The momentum does show you that, it looks and it feels like a distribution event in the markets right now. But what we can also see is very strong market breadth and very strong market rotation, a lot of ETF inflows into the US, right? It's not as if people are just leaving the entire markets. When we take a look at these super investors, a lot of them have been net buyers. A lot of the funds have been net buyers, and cash levels from the Bank of America Fund Manager Survey have been very low as well. So people are deploying into the current market environment right now. Now, some people could argue that, well, since everybody's deployed, where's the new money going to come from? That just means they're setting up for a rug pull. And you can make an argument for that. I wouldn't disagree, but at the same time, right, it's very difficult to be bearish on this market. We can be bearish on the short term for the narratives at play right now, short-term volatility, some liquidation breaks, right, make people panic, but it's very tough to have a recessionary view of the current market environment right now. So keep all of that in mind. We will just have to take this one day at a time and see whether or not we get the liquidation break leading to a retest of our monthly EMA. The good old 12-monthly EMA is just sitting down there ripe for a retest. It'll be curious to see if the market has the juice with these bearish narratives to put us down there, right? And the same thing can be said with the QQQs. So the QQQs have been the weaker component, of course. We've also spent a very long time under the 50-day EMA at this current time for about the past 2 weeks. And this one, contrary to the SPY, is looking like it wants to continue the breakdown into the bearish downtrend continuation. Now, it's a change of a regime because the last time this happened, end of November, you had a quick snapback, even though you were in a daily downtrend. This time, no, they back tested it once and we're still hovering under, and now we are under the area of resistance, 605 to 613, which is also where your moving averages are sitting. So you're going to need something big to get us over and above that level. Will it be NVIDIA earnings next week? Will it not? We'll have to see. But at the same time, you've had this 200-day EMA. Look at all this space between us and the 200-day EMA, and that's been slowly grinding lower in terms of the distance, right? We're very close to the 200-day EMA. So some people might see a lot of nervousness in the markets right now. And that could be true. But the opposite end, right? The markets right now normalizing closer to the longer standing moving averages means also that if you have some bullish catalysts come to the markets or you dissipate a lot of the short-term bearish fears, well, you got a lot of room to lift as well, right? Weekly RSI is nowhere close to being overbought. Daily RSI is nowhere close to being overbought. You're very close to the EMAs. You're very close to the 12-monthly EMA as well. So if you do get that bull rally in motion for this year, you can get a lot of lift before you would be considered overextended. extended, so keep that in mind. As of right now, best time frame is just this one. It's monthly consolidation with a downward bias. Some people may call this the pure distribution cycle, and that may be true across certain names in the market in terms of a big pivot away from large cap into other names that haven't been favored for the last 3-4 years that are coming into favor now, such as industrials, such as staples, and things of that nature, right? So many ways to interpret this market. We're just here to say that there is something for everybody in this market. That's the moral of the story, right? There's something for everybody, whether you enjoy playing emerging markets, whether you enjoy playing metals, whether you enjoy playing the defense corporations that we raised earlier in the year, right? Whether you enjoy playing small caps. A lot of small caps have been very good lately, right? So many key themes, right? Whether you enjoy playing memory stocks or things of that nature, whether you enjoy playing the data center connectivity plays, such as, Coherent, or such as ANET, or such as VRT, or there's something for everybody. There's still pockets of the AI trade that are doing very, very well. There's pockets of the whole value and energy side of the market that are doing very well as well. The defense corporations are doing very well. So there's definitely something for everybody. But if you're just a pure SPY, QQQ, and large cap growth investor, you probably haven't been doing too well, right? Which is why we say it's been a true stock pickers market to start off the year, more so than any other years prior. Moving on to XLF right now. So XLF, another big sector that hasn't done anything right now. You need to set some higher lows and change the daily uptrend, right? So far, no daily uptrend. They lost the daily uptrend with this big flush right there, and now we're kind of looking to get it back. Good thing though, we are bouncing out of a very big area of structure, and you can see that best on the monthly time frame, 52 down to 50. And there's so many interesting themes in XLF. XLF, I'm very bullish on for this year overall. Whether it's the banks pulling back, like Bank of America, pull back in a 50, could be an interesting location, whether it's JP Morgan as well. JP Morgan, if we pull back into the, lower 290, 280 area, which is a retest of the 12 EMA, they've just been stuck here for the past 6 months. Very interesting, whether it's companies like Visa and MasterCard, right? Also very interesting plays, or whether it's the entire insurance landscape. Insurance hasn't been in favor. And if you take a look at this ETF, if my charts would load, sorry about that, it's been flat for the last 12 to 14 months. So rather than picking apart individual names, if that's not your thing, you can just play the XLF ETF overall, as I do think many components in here have a good degree of lift potential into the next 3, 6, 9, 12 months type of thing in this current macro environment. Moving on to healthcare right now. Healthcare is still doing a whole lot of nothing, so we're not going to spend too much time on it. The bulls are looking for the daily uptrend breakout here, and that breakout would need to see some closes above 160. Can't get 160. Well, sadly, you're just going to get right back here into the bull flag gulag. And it's a bull flag because, well, I mean, it's right there, right? My ability to draw on this chart is terrible. Forgive me. It's a bull flag, right? No other way to cut it. Moving on further, weekly 12 EMA is looking really nice. So the bias definitely is long on healthcare. But if for some which reason we do pull back and go for the monthly downwards break, we're coming right back in here, 150, 145. That would be a beautiful cup and handle monthly breakout retest and possibly run for your healthcare bulls. So that's an area that I'm paying attention to if it breaks to the downside. Moving on to semiconductors right now. Semiconductors down again today. Just not much movement overall. So line in the sand remains put at about 398. If you flush this lower high and a lower low, that's your daily downtrend and would be signaling that you're heading into a bit more weekly consolidation. Possibly the next area would be the weekly 12 EMA. I'll remind you, this trade is very extended on the monthly time frame as well. You got a lot of players there that haven't been running. We bring them up almost every single video, right? You got the Broadcoms of the world. They haven't done anything in like 4 or 5 months other than backtest this 12 EMA perfectly. Broadcom is very interesting. Marvell is a very interesting play as well. And obviously NVIDIA is a very interesting play into their earnings. They've consolidated for the past 5-6 months. So, I mean, if the key here is spending, NVIDIA is going to get a lion's share of that spending. So you would assume, right, that even if the rest of the hyperscalers don't do well because of CapEx concerns, well, who's getting that money? Well, NVIDIA, Broadcom, and AMD. And those names haven't been really doing much in the past 4 or 5 months. So keep that in mind. You have some cohorts of semiconductors that have been performing really well recently, such as the equipment manufacturers like Lam Research has been performing really well as of late. You also got other names such as ASML, which have been performing really well as of late, holding up the gains. You got companies like TSMC. So the picks and shovels, basically, right? or the machines that make the picks and shovels, ASML, LRCX, those companies, or TSM directly, they've been performing well. And of course, we're going to talk about SanDisk and Micron. The memory shortage is continuously a very popular trade right now, whether you're taking SanDisk or Micron for a swing trade higher from here. Obviously, the narrative makes a lot of sense. The forward multiples are very low, or whether you want to play the Korean players, which we highlighted yesterday, which are trading even cheaper than SanDisk and Micron in the names of SK Hynix and Samsung. 46% of this entire ETF is just those two names. So that being said, right, this is also an ability to, or a fashion that you can play a portion of semiconductors that are really, really hot right now. So please keep that in mind. The other ones, like the equipment manufacturers, they're trading very rich. They might have a very big backlog, but they're very rich. The only charts that look like this that are trading still cheap are Micron, SanDisk, and EWY. So keep that in mind, right? If you're looking to play extended charts, you may as well play the extended charts that are cheap, that, probably still have a good fundamental expansion thesis behind them, rather than playing names that are kind of at the top end of their range. They're looking healthy, but they are at the top end of their range. And now lastly, moving on to the good old Russell 2000, IWM. So IWM up 0.23% on another day where the markets are red. I mean, this is why it's so funny. Such a funny market that you're in right now. So there's clearly a move for a risk-on trade right here. The IWM has been outperforming. It's so funny to see how bifurcated the market is right now. We keep bringing this up, right? Large cap growth in the middle, or just large caps in general, have been out of favor. The two extremes, though, have been very much in favor. Large cap defensives, such as value, industrials, some of the oil companies on one side. So you got very slow moving companies that have been moving very fast recently. Then on the other end of the spectrum, you got growth. Usually when you see that, it means that the macro backdrop is very favorable to where, some of the value companies, they would only get bid up if they know that the macro backdrop is very favorable. But growth stocks are the same thing. You don't usually bid up growth stocks like this if you think that you're going into a recession. That's just not going to happen, right? So that being said, the IWM is setting up pretty nicely here. Just sideways consolidation, looking to get a little bit tight here, maybe looking for the expansion move at the same time. The weekly does show that at the same time as well, to where this is just forming a nice little bull flag here, respecting the 12 EMA. And with the bullish leaning bias, the upside break is somewhat likely on the Russell. The Russell moving very nicely here from those April lows, just not looking back. So really outperformance, guys. I mean, it's so funny. Equal weighted SPY and Russell. You usually do not see that combination. So it is indeed a very strange market right now, but hopefully when we spend so long on the introductions recently over the past few weeks, hopefully it's kind of helping you find these rotations and determine why some of these rotations are happening. So keep that in mind. We're not going to go through our other minor sectors because we spent a lot of time talking about them this week so far. The VIX remains a bit of a pain point for the market, right? A bit of a head scratcher right here. The VIX remains at 20 because of the shorter term bearish catalyst that you currently have on the market, right? The Iran situation is not helping. Supreme Court tariff decision, obviously. The AI mess that is currently throwing a lot of volatility in some of the software names, some of the large cap names, right? So volatility right now is very high. People are buying protection against their bets. At the same time, it's a good time to be either writing covered calls on some of your bets because the premiums are going to be very juicy, or selling put options on your favorite companies if they have been low and you're looking at possibly playing the wheel on those companies. So in a high VIX environment, option selling is still the preferred way to go, because if you're buying options, especially short-term options, you're paying a lot of extrinsic value in terms of premiums right there. Not that you can't make money, it just makes it a bit harder to make money, especially if the VIX somehow has a crackdown there. You lose a lot of extrinsic value just from IV crush alone, so keep that in mind. Moving on to gold right now. Gold not looking too bad overall here, guys. They're trying. The bulls are really trying to set up some form of a trend change and break above 5,070, 5,075. So we'll see if they can do it. The line in the sand currently remains right down here, 48.32. If you lose that, sadly, the downtrend is back in motion for your gold bears. So far, they've held up the moving averages, in a very nice fashion. 26 EMA on the daily time frame has been the one that the bulls have defended. Coincidentally as well, on the weekly time frame, they never lost any of the weekly time frames. But we did say that after such a big steep drawdown like this, it's very hard to just V-shape. If anything, if the bulls want to continue, they'll probably have to do it in 2 stages, and that's exactly what you're seeing right now, right? The lower high, trying to set the higher low and go for the weekly uptrend recapture. So gold is not looking terrible right here. The bulls still control all the time frames. They control the monthly, they control the weekly, and for now at least, they are reestablishing control on the daily time frame as well. Moving on to silver right now. Silver was also up about 2% on the day for the Thursday session. So you got a nice MACD coming in here, showing that most of the volatility might just be behind us at this point. Not as good as gold, though, in terms of structure, but they are trying for something. Right? Clearly trying for something. So if we're trying to take silver longs here, very easy tradable bottom right now, tradable lows, 72 would be a very tight area to trade because you're looking for the daily uptrend shift. You are also looking for the weekly momentum recapture. They've defended this weekly 12 EMA with their lives recently, even after this massive liquidation flush. And now, just like gold, we're looking to reverse the time frames one after the other, right? So first comes the daily, then comes the weekly leg of expansion, but after such a deep retracement, I don't think that they can V-shape this just like that. It may have to do a bit like gold, where it tries to do it in two different steps, but you do have a definite tradable bottom right here with a stop loss if you're looking for re-expansion towards 90 and consequently back up to the $100, $110, $120 range right there. Very clean setup in my humble opinion. But always remember to trade with a stop loss, because the last thing you want to do is get unwound and head into more weekly consolidation and more monthly consolidation down back into the 60 range. So keep that in mind if you're looking at gold and silver. They're very clean setup. Something that's not a very clean setup right now is Bitcoin and Ethereum, right? Bitcoin and Ethereum doing a whole bunch of nothing. They are just dead to the world. 74,000 out of 66 is your last line of defense. No daily uptrends. They're trying something here, but at the end of the day, right? If you just zoom out where you are in relation to that move, some people could argue that this is a bear flag, and I would indeed agree, right? The same thing happened at our last area of consolidation right there, to where steep move down, consolidation, refusing to set the weekly uptrends, bear flag into the crush, right? So are they going to do the exact same thing right now, to where they tease the daily uptrend breakouts and it just never happens and we just roll over? Well, until we get a new daily uptrend, it's very tough to be bullish on Bitcoin, right? So you need a daily uptrend to be able to say, all right, that's our weekly low, and then we're looking for the reset of the time frames, just like gold and silver are doing right now. But so far, no action, right? Weekly downtrend, daily downtrend, weekly 200 EMA. Yes, this is true. The monthly time frame, though, is just destroyed right now. So longer term bets on Bitcoin and Ethereum for a longer term thesis, yes. Very tough to establish some swing trades for some longs right now unless you keep a relatively tight stop loss, because the last thing you want is just get unwound by the continuation of the downtrend and going to our lower support area of 60 down to 55K. So if you are trading this one, trying to call the bottom, you better be trading with the stop loss. And the same thing with Ethereum, the exact same pattern, although this one is consolidating under our area of previous support, which is now resistance 25, then about 2,000. This one looking incredibly weak right now. So until we get some daily uptrend shifts, Bitcoin, Ethereum, just not really the place to be for short-term momentum in the markets right now. So keep that in mind when you're thinking of a crypto environment right now. That's everything for our overall market rundown. Now let's dive into big tech, and after that, we'll do our biggest gainers and losers. All right, so let's talk some of the big tech names, shall we? So moving in first to Apple. So we always bring up Apple first, and well, because it's first on the list, but what we've been bringing up on Apple is the fact that the company is somewhat overvalued right now. And you can clearly see that around 270, company's trading for a 32.4p, a 3 peg right now. Not taking anything away from Apple. They've been holding up better than most big tech companies out there because, let's be honest, they just haven't spent the hundreds of billions of dollars in free cash flow. They just keep doing their buybacks. They're not doing massive CapEx projects. They're partnering with Gemini for AI purposes with Siri, and they need very good earnings print. So that being said, am I buying Apple up here? No, but would I reconsider it? Maybe if we dip under the 250 to 245 level as we continue into monthly consolidation, looking for this absolutely gorgeous monthly setup of the breakout, retest, and possibly run into the rest of the year, as Apple's product releases are going to be very good this year, and they still have a tremendous amount of demand. Yeah, I would not mind participating in Apple since it largely has not lost the monthly uptrend, such as many other names on this list. Moving on to AMD right now. Well, I mean, AMD, the thesis is definitely not dead, not even close, right? The only thing with AMD is that if you want to see the biggest portion of the thesis come true, which is the massive ramp of their MI450, MI450Xs, that's going to come late 2026 into 2027 for revenue and EPS. So they will be expanding margins in a phenomenal fashion, expanding revenue in one of the fastest clips in the company's history right now. It's just now you're in a bit of a consolidation period. So although we do not have and this is something we've discussed all week, we do not have the daily uptrends. If you want to see the bulls back in control, you got to give me the daily uptrends first, and that'll be a break above 220 to the upside and challenge this resistance area again. That will let you know your consolidation phase is finished, and the bulls might have a second chance. As of right now, just consolidating. So while it's consolidating and while the thesis is still very much alive, I am a big fan of adding some AMD shares here through about 175, and even playing some short puts under the market is something that I have been doing fairly regularly, as at 210 the company is still very cheap in my humble opinion, trading under a 1 peg. Moving into Amazon. Amazon obviously has been struggling, as the rest of the Mag 7 has too. Daily downtrend, so same concept, right? Until you get these daily uptrends back, which would be something like this, either the two-step process or just crack these highs 213 and just get the engulfing move and start the recovery process of the now resistance range 216 to 205. Until the time that that happens, the bears control the short-term time frame. So support remains below 197 down to 189. Still a great buying opportunity for Amazon. Longer-term buys, such as very long-term leaps or shares for the expansion of the fundamentals of the business in the long term, that is the best type of trade here, because the short-term swing trades, tough to do without the short-term timeframes in our control. That being said, the weekly has now been lost, and the monthly timeframe as well has been unwound all the way through the 226 EMA. Usually when you find Amazon so much off their all-time highs in the 26 EMA, it is a great buying opportunity, but it is a buying opportunity that has to come with a bit of patience. One of my favorite companies in the market right now, but we know still wildly out of favor with the rest of the Mag 7 names, or a lot of them rather, except for Apple maybe. Google also daily downtrend under your EMAs, which has been a concern for us ever since they lost them after earnings, and they really haven't got them back. So daily consolidation on Google continues. We are now very close to daily oversold conditions. It doesn't mean that that can't just result in a bounce and lower lows, as you're now under your EMAs. Google is in a very nice consolidation phase right now. Line in the sand, 297 on the break of that. Well, unfortunately, you'll have lost all your weekly momentum, and you will be into the phase of monthly consolidation that we've been talking about on Google for a while. I've been waiting for this phase because I haven't done anything on Google in like the past 4 or 5 months other than riding shares, but I haven't been initiating net new longs or trading the wheel or anything like that. But talk to me under the $300 range, 280, 275, when they curl into the 12 EMA. At that point, the company would be down from the highs, roughly the same as the rest of big tech, right? 20-25%. If it happens, I will play, but as of right now, I'm just holding as around 300. If you take off 10% off this valuation, it's still trading around the top end of the range, meaning you're not getting much of a big deal here on Google. Phenomenal company, but not much of a big deal. As a result, I'm just holding, not a buy, but also not a sell for me. Meta, also flat on the day, 0.24%, desperately trying to hold on to this 645 down to 630 range. Same concept as a lot of other big tech names out there. Daily downtrends, full bear control right now. The weekly has given back a lot of this acquired momentum into earnings and post earnings. They've given it all back, right? So you're gonna need a big move on Meta if you want to reclaim those timeframes. You also have a bit of a head and shoulders pattern here on the monthly time frame, which if the prophecy does fulfill, you're coming right back down here into the 600 to high 500 range, which would be a phenomenal buying opportunity on Meta. I just keep DCing Meta little by little because as we keep trading around these very cheap valuations, I just want to get as many shares as possible. As we know, Meta hasn't done anything, guys. It's at the same price it was last February, although they've improved their fundamentals in a wild fashion, right? The company's still trading a low 420 multiple right now and a 1.17 peg. So Meta, in my opinion, one of the best they're all very good in their own respects, right? It's just Google and Apple are a little high right now, but Amazon, Meta, Microsoft, and arguably even NVIDIA, AMD, very solid picks, especially in terms of their forward valuations. Speaking about another one that's been wildly out of favor, Microsoft. And Microsoft, the bears still control all of the short-term time frames. Your lower high is right here, 423. So if you want to see the bulls do something, you got to give me the daily uptrend back. Until the time that happens, the bears control all the short-term time frames. Now we are into support right now, 410, down about 385. The weekly, full bear control right now, and the monthly as well, full bear control. Big consolidation phase. We did fill the gap from last May earnings, so that's a good start, right? And you're very close to your 50 monthly EMA. That very rarely happens on Microsoft, which is why it's such a phenomenal buy right now, but you will have to be a bit patient because it's just out of favor narrative wise. I mean, a lot of large cap growth is out of favor, but Microsoft especially because it's being too closely tied to the RPOs generated by the OpenAI deal right there. But that being said, around 410 or lower, you are getting a very good discount on the stock. So long-term investors and patient investors will definitely be rewarded in this one. Even 2-year leaps or something like that are a good opportunity, which is what I've been capitalizing on right now too. But in the short term, very tough to initiate any short-term swings right here unless you're, without the confirmation of your daily uptrends at least. Moving on to Netflix right now. Netflix down 1.27%. This stock can just not catch a break. Eventually, you will need to change a couple things, right? Number one, it's been a downtrend since the month of December. Actually, or earlier than that, right? Since early November, right? It's just been a perpetual sequence of lower highs and lower lows and just grinding down this 12 EMA. So the bears remain in full short-term control of Netflix stock right now. You're right up against your 200 weekly moving average. That does not happen too often. Once in September of 2023, and then of course they got unwound completely in 2022. But prior to that, in a non-bear market, some people will argue that this is a bear market, but I'm talking about when the indexes are down 15, 20%, right? Other than that, Netflix usually doesn't revisit this location. But you know what the problem is? It's the Warner Brothers deal again, right? So although you're deep weekly oversold conditions, almost the most oversold that the company has been since either 2011 or that big 2022 sell-off, there's just no action here by the bulls. You need to see them reclaim this 12 EMA and reset the daily uptrend. Until that time, still a falling knife, still great accumulation for long-term investors, but any short-term trades, it's just a falling knife at the current time, right? Moving on to NVIDIA right now. NVIDIA just basically still flat. They have earnings next week, which will be on the Wednesday session. I'll cover that for you guys. Yeah, my flight's on Thursday. So I'll be covering that for you guys. So keep that in mind. Oh, no, actually, I'm still here for another 2 weeks. My bad. So NVIDIA probably may not move until earnings, guys. That being said, it's going to move 7 to 10% after earnings more than likely. If we somehow come back down here, it'll still be a phenomenal buying opportunity. I think NVIDIA is going to give phenomenal earnings, insane earnings to be specific, right? But we know how the market's been treating very good earnings. The market, companies can report very good earnings, and yet they can still just come down. At least that's been the theme for a lot of these Q4 releases. So we'll see what happens on NVIDIA. Valuation here in the 175 to 180 range is very fair. Low 20s multiple and around a 1 peg for this great company. So I will stay accumulating NVIDIA throughout this massive range, right? And I do believe that the breakout will be coming in 2026 because eventually you can't hold back all the money that this company will be making overall, so please keep that in mind. Moving on to Tesla. Tesla still not doing too much, right? Still trapped in its own daily downtrend. So that being said, the bulls are trying something here, trying to set up for the higher lows into maybe a higher high break. But Tesla's going to be a case of rising tides lift all Teslas, or sinking or fleeting tides sink all Teslas, right? Basically what I'm trying to say is it's going to move with the cues. It has no choice, right? So even though Tesla is doing great things with FSD, with their energy business, with their Optimus ramp, which will be coming into 2027 probably, right? Stock's just been out of favor with the rest of the Mag 7. So that being said, a daily downtrend, weekly also giving back most of all your gains right now. So no momentum. The clearest time frame for me remains the monthly, just in a phase of monthly consolidation. Tesla hasn't really done much over the course of the past 5-6 months. In terms of breaking out here during the month of December, since then it's just been big consolidation into the 12 EMA. So this support range is super clutch for Tesla, guys. 405 down to 385. You do not want to see the bulls lose that overall. No swing trades on Tesla for me. Just holding some of my long-term shares. Moving on to Palantir right now. Palantir also, this stock also cannot seem to catch a break, whether it's, social media debates with Michael Burry or just being lumped up in the software trade, even though it's one of the companies that is disrupting a lot of software companies out there. It's just getting lumped up into a lot of negativity right now. So Palantir just not, he's a shadow of its former self, where it seems as though in the past 2 years, they could do no wrong. All dips would just be instantly bought up. Not this one. This has been one of your more extended phases of consolidation, unless you take in consideration the tariff event from last year. So daily bears still control the trend here, guys. No secret about it, right? You're going to need to see a lower high and then a higher low, and then a higher high form if you want to see the bulls manifest any form of short-term strength. 127 down to 116 is the area to keep a lookout for. I mean, at least it's not flushing the levels anymore, so keep that in mind, right? And as soon as they do turn the daily timeframes around, well, you would like to see them claim the 148 down to about 139 area, because if you can mount above that, well, it'll give your weekly bulls a chance to mount a bit of structure and change the trend and put an end to your monthly consolidation phase. So keep that in mind on good old Palantir. Palantir's done a wonderful job recently, though, in cooling down the monthly time frames. We know that most people's concerns are surrounding the valuation. I'm still a long-term Palantir shareholder, not selling any more shares. And as a matter of fact, I might even be looking to reload some of my sells that I did in the high 100s in terms of repositioning them into the low 100s, just to benefit from a bit of a double dip action. Moving on to SOFI right now. SOFI, same concept, still wildly out of favor, right? Daily downtrend, the bulls nowhere to be seen right now. You're going to need a break above 22 if you want to see the bulls reclaim this daily uptrend and start moving through the resistance area, which is 25 to about 21. It's a big box that the bulls held for so long, and now unfortunately they unwound it. It was the peaks from 2021. And now I put a yellow line here because we're in the middle of nowhere. There's literally nothing here to support us, guys. I mean, you could argue that maybe there's a few small little interim levels, but let's be honest. The big one is up here, and the other big one is down here. Bigger support level 17 out of 15. So I'm a fan of buying SOFI down here, accumulating some shares, but you have to be open to the premise of having to DCA if we go for the more full retracement down there into the wide support range, which once again is 17 down to about $14. So SOFI is still a company with a lot of growth, and at 19 where we are right now, trading at a very fair forward price earnings multiple with all that EPS growth and a very decent peg too. Moving on to Uber, another company that has just not been able to catch a break recently, still similar to a lot of names on this list, daily downtrend, and your lower high being right about here, 77. You need the bulls to put in a nice move and reverse the daily time frame. Until the time they do that, the bears are just always looking to short these lower highs into a more aggressive downtrending setup. So that being said, we're trying desperately to hold on to 70 psychological support. Anything below that, you're coming back down here to 64 to about 55. Now, although Uber bulls don't control the daily or the weekly, and the monthly has seen significant downside recently, long-term again, guys, a lot of these charts, right, we shouldn't be looking at them for short-term swings. They're all out of favor for short-term swings, and you do not have the uptrends. Much easier taking swing trades on stocks that are in, large daily and weekly options that haven't lost momentum. Now you're just looking for trend reversal trades, and trend reversal trades are some of the toughest in the book to time correctly, especially when you do not have the medium-term time frame, such as the weekly, in your favor. Although at $75, if you're a long-term investor, nothing wrong with buying Uber down here. Matter of fact, they have a great valuation at a low 20s multiple and around a 1 peg. And last but not least, good old Taiwan Semiconductor Corporation. So TSM down about 0.52%, but we haven't really lost any structure whatsoever, right? This is what I mean when I'm talking about finding companies with good short-term price action for continuation longs. You're looking at a continuation long pattern right here. Back in a 350 could set you up nicely for a continuation long on good old TSMC. Picks and shovel, high moat, obviously, right, guys? Weekly is in a uptrend, so contrary to a lot of other stocks in this list, it has not lost anything. So these further higher lows are just going to be for further trend continuation trades, and the monthly remains a little bit stretched right now. However, we have not lost any of the minor time frames, so we cannot say we're going into monthly consolidation anytime soon. That being said, around 340, am I buying? No, I'm just holding all my shares. In my opinion, I'll be waiting for more of a pullback to add to TSMC. I mean, over the past few years, guys, I've accumulated all the TSMC that I could possibly ever want, so I'm not looking to buy into this company, but any steep discounts that you may find from any further index consolidation that would lead to some of your favorite names coming down, TSM, pay attention to it. If ever you find it down here, again, in the lower 300s, that'd probably be a nice area, and the valuation would come down a little bit, giving you a much better discount. So I'm not selling any, just holding what I have. And that is everything for our big tech list rundown, our index rundown, a massive intro that I did for you guys. Now let's get into the biggest gainers and losers of the day. And similar to what we do in other videos, sometimes I go through these names individually. Some other times I talk about the themes. So now today, we're going to talk about some of the themes that you can find across this list of names that have been coming down recently that could be interesting. And also some of the names that have been popping off recently. Are they still good buys? So we'll try to run through not all the themes, but some key themes that you guys should be paying attention to. So the number one theme on everybody's mind must be software. So we'll take a look at IGV. So full disclaimer, guys, I have a position on IGV. I'm looking for a little bit of a risk reversal trade, right? A bit of a mean reversal trade. Not looking for new all-time highs. No. Just looking for weekly oversold conditions to kind of retrace possibly up higher to the mid 90s on IGV. Now, there's a couple ways to play this. Either we can play individual companies or we can play the ETF. I have a little bit of both. Now, that being said, IGV, very interesting trade right here, but there are several other names, very nice compounders in the whole software landscape that are worth a second look, right? One of them that's come down significantly recently is AppLovin. AppLovin had phenomenal earnings, trading at a cheap valuation right now. They're into a very nice area of support, which is the low 400s. And coming out of oversold conditions as well. So AppLovin, very decent. Reddit is another one of those, right? It is, at the end of the day, social media, yes, but being lumped up in software because of advertising and other things of that nature. Reddit had very strong earnings at 145, where they are right now. Very compelling valuation, right? It is under a 1 peg as well. Both AppLovin and Reddit are under 1 pegs currently, so they could see some nice upside. In comparison, you have some cybersecurity companies that have just been perpetually coming down. The difference is in the valuation, right? So although you may want to buy Palo Alto's dip or CrowdStrike's dip, they're not cheap. They're very expensive. Whether it's CrowdStrike at 420 being over a 3 peg, Palo Alto Networks down here at 150 being also very close to a 3 peg. Cybersecurity is not something that I'm specifically loading up on right now individually. It could be interesting to play through the intermediary of an ETF, such as CIBR, if you don't want to pick apart these names individually, right? There's many ways to play this software dip. Now, some of the legacy are some of the ERP names, right? Like ServiceNow and CRM. I'm not playing. If I were choosing to play them, I would take a mean reversion trade on them only. The reason being, guys, is that every single week, every single month, you will have to contend with new software headlines. So am I adding these companies to my long-term portfolios? The answer is no, because the next 3 to 5 years for these companies are more uncertain than they ever have been. It does not mean their businesses will go to zero. It just means that their narratives will be perpetually challenged, which is why it's a very difficult trade. And the same can be said about companies like Adobe, right? It is a stock that's trading at very, very cheap valuations. Adobe is not going out of business anytime soon, and I would not be surprised if they keep delivering very solid earnings. The only problem is, for every upswing that you get, you will just get perpetual new articles that come out, such as this one right here, right? The Google Labs one that we just came out today, right? So there's just going to be a continuous onslaught of narratives against these companies and releases, new Gemini models, new Claude models, new ChatGPT models, etc. Right? So these, for a long-term investment, are arguably more uncertain than ever at this point in time, right? So I'm not choosing to play them, especially since a lot of them don't have excessively strong growth. Like, I'll play companies like AppLovin, I'll play companies like Reddit, but I'm not going to be playing legacy players like Adobe because they have huge, massive growth rates and very high margins, right? That's the only reason why I'm playing them. I mean, you look at AppLovin's revenue and EPS growth and their operating margins and net margins, it's a lot easier to play. You take a look at Reddit, it's the same concept, right? Very, very strong net margins, very strong revenue and EPS growth rates. It's very solid. Take a look at Shopify, e-commerce business, which has gotten hit recently too because of the AI agents and stuff like that. Revenue and EPS growth is fire, is absolutely fantastic right now, even though they are a bit expensive. So this is one I would be playing, but I'm not going to play Adobe. I'm not going to play Adobe. I just won't do it. The revenue EPS growth rates are not there for me, right? ServiceNow, even though they have decent growth rates, I'm still just not that interested in playing them. At 117, it's a 1.65 peg. I can find Mag 7 names trading for cheaper than a 1.65 peg. So why would I do that one, right? You know what I mean? So they're okay for a mean reversion trade, these businesses. And who knows, if you hold these businesses long enough, you may make some decent money. But I'm not going to sit in them. I feel that I can make some decent money in other locations and software as well, which is why I'm not playing them. And even Intuit, right? Intuit, I mean, you can argue that they could possibly be disrupted by AI, but also keep in mind, right? The US government is going to put out possibly their own tax software, which will allow people to file their taxes pretty much for free using government software too. So this one has just been wildly out of favor. Such a high quality company, but just still not one that I'm interested in. I think there's stocks with a clearer narrative, even though it's at some of the cheapest valuations ever. It's like a 17 forward price to earnings. These are cheap, and I'm playing these, but through the intermediary of IGV. And I'm just looking for a mean reversion trade with some shorter term call options to profit on the upside, but I'm not looking to stick around I make a bet on whether or not these software companies are going to recover in the next few years. No, I'd rather play certain companies specifically that I've chosen, or I'd rather just play other key themes that have been in favor, right? So now that we've once again touched upon software and how I'm trying to play it, and shout out to booking.com. I'm playing booking.com on this decline. They had fantastic earnings, but this one got sent down. So see, there are some names out there that I think have more resilience towards the AI narrative than others, such as booking.com, such as SPGI, such as Moody's Corporation. So I'm playing those, just a personal choice. But maybe not so much the other ones, that we previously named, such as the ERP softwares like the Monday.coms or the Workdays or the Intuits of the world or things of that nature, right? So keep that in mind. That's just my personal choice. Now, moving into another very popular area of the market, we are going to talk about good old industrials for a moment here. So you may notice that there's several companies like John Deere. And these companies, guys, at this point in time, they're trading for very lofty valuations, right? The big tech names are a lot cheaper than a lot of industrial companies in the market right now. DE is very high. Company like Caterpillar is very high. Company like GE is very high right now. Very extended, whether it's on the weekly or the monthly timeframes as well. So you may look at these charts and think, man, do I actually want to play this? Well, there's a lot of bloated stocks. They're very solid companies, but their valuations are getting a little bit stretched, yeah? The last time we brought up one of the industrial plays was GE Vernova. And GE Vernova down here was indeed a buy from October through the December period in the 600 range. Now it's kind of gone, but this one indeed is a hold for me. I like it, directly exposed to the data center narrative overall, and their backlog is absolutely massive. So GE Vernova, probably one of my favorite players here. However, there are other plays in the industrials niche that have looked pretty good for a long time now. And one of them is CP, right? As part of the whole industrials broadening out trade, take a look at CP. CP has been range bound for the past 4 years. Very solid company, very good margins being a railroad company overall. And if you take a look here, they are actually going for fundamental expansion. If you notice on EPS, it was flat for a while. They're finally re-expanding EPS and they're finally expanding revenue in a nice fashion too. So CP, this one, after 4 years of accumulation, if you're looking for a big bull break in a sector that's very in favor right now, CP, it's been one that I was highlighting at the lower end down there. It's been a long-term holding of mine for a while, and every time over the past few years that it's come down to the lower 70s, I've been just nibbling. Not a very large position compared to other things in my long-term portfolio. It's like a $20,000 position, which is still big, but you know what I mean? Not as big as some of my other positions, not even close, but this one could be very interesting, right? So just, there are a few players in here. We don't have to chase some names that are super extended. There's some names that are looking very strong for some possible breakout potentials recently or continuation potential with current industrial themes underway right now. Then there's the whole energy theme, right? We talk about this one a lot. There's many different ways to play energy. We can play energy just through, oil and gas. Oil and gas has been a very popular one, but arguably it's very extended. If they choose to give us a re-entry opportunity, obviously recently energy's been catching a secondary bid because of the Iran tensions, but it all started a lot earlier than this. We were commenting that Leafs were a great trade right there. Hopefully some of you guys are able to eat well on this trade overall for the oil and gas expansion. You'll see that, Chevron, the Venezuela thing helped as well. Chevron, very high, looking for a back test eventually. ExxonMobil is just gone. You'd be hard pressed to find a back test anywhere in here. So oil and gas. But what I've been doing is playing some of the midstream pipelines, such as Enbridge, right? For data center purposes, Enbridge, not too bad. Energy Transfer Corporation, not too bad. That's oil and gas. That's just how I'm playing it. I'm not the go-to oil and gas expert on YouTube, obviously. There are people that know far more about this industry than me. I know my fair share, but these are the picks that I've made overall. Either XLE or my midstream pipeline niche is something that I'm playing. We can take a look at other energy companies like Vistra, which do natural gas, nuclear, solar, coal, and battery storage. Obviously, you guys know me. Renewables, namely solar and battery storage, are going to be very popular, but some of these independent power producers such as Vistra could be very interesting. NextEra Energy as well has been very interesting. We brought it up tons of times during this $80 consolidation range, and we were saying what a beautiful pattern here going for the legacy breakout. This beautiful cup and handle into monthly expansion here. Beautiful breakout, the back test here attempt, and looking on to run. So NextEra Energy has been flat for the past 4 years. So this one also a very interesting pick. And then, of course, we have my smaller ones like T Energy, right? Vertically integrated solar, which is my small cap pick. This one, very interesting. From here all the way down again through the $5 range if they consolidate a little bit more. Tremendous backlog for this company. It's trading at a $1.71 billion market cap, but if you take a look at their forward projected revenue streams, I mean, they're very, very large here, guys, right? 2026, 2027, 2028, 1 to 1.8 billion. Very, very, very popular overall. So keep those energy trades in mind. Many ways of playing energy. You can even play URA, right? We didn't even talk about Constellation Energy, which should do quite well. They've just went through a big consolidation phase, or the CCJs of the world, right? The uranium miners and things of that nature. If you don't know which way to play uranium, you can always play ETFs like URA, or ETFs such as NUKZ, very popular ETFs in the entire nuclear markets overall. So the whole energy component of the market, that's going to be the next bottleneck, guys, right? Bottlenecks have been a very popular trade recently. If it's anything from memory or copper or things of that nature, right? Pay attention to energy, because energy is going to be a huge bottleneck, which is going to be a very popular trade into the next few quarters and next few years, arguably as well. Now, another very popular trade is everything from aerospace, defense, and robotics. Okay, so, and that's a very wide segment. So some of the military contractors up here this year, Lockheed Martin has been absolutely just crushing it, right? After years of consolidation, look at this massive breakout on Lockheed Martin. Tough to chase. Look at RTX right now. RTX, tough to chase all the way up here. NOC, tough to chase some of these players. But some of the smaller players, such as drones and whatnot, right? AVAV, nice consolidation. I've been building a position in this stock myself. Lower market cap. Some of you guys like Katos, right? Katos had a very nice pullback recently, although now it's quickly making its way to the highs. This was a very nice level. We were talking about it, right? 80s down about 70s was the pocket. Pay attention to this one, right? Again, one of your smaller drone companies out there. Some of you guys enjoy Ondas as well. Also another smaller cap player. So keep all that stuff in mind. Drones, defense, going to be very, very, very popular, guys. So definitely something that you should be paying attention to leading into this year. Even some of the shipbuilding companies, right? There's been a big shipbuilding niche, Huntington Ingalls and a few more. And look at these charts, right? Defense has been a massive place to be. And not only that, the space trade has been doing really, really well recently. Rocket Lab, we were talking that, even I was interested in building a position under 70 down through about $50 was my area, right? Wasn't able to get that many Rocket Lab shares off in the sub 70 area, but space trade is going to be very popular, whether it's Rocket Lab or, ASTS. Are the two that I prefer. I prefer Rocket Lab personally, but pay attention to the space trade, right? This one, you're gonna have the big SpaceX IPO, or whether it's some of the smaller ones, like sometimes you guys want me to talk about, the Planet Labs of the world, or the Red Wires of the world, et cetera, et cetera, et cetera. Pay attention, because there's a lot of opportunities here in some of the space trades, right? I try to bring you guys as many plays as humanly possible, but I obviously can't cover everything and the thesis behind each one towards the end of the videos right here. I'm just giving you many ideas and many key themes to pay attention to this year. Another key theme is going to be critical minerals. And we know the U.S. government just made a direct investment into USAR. USAR has been coming down in a substantial fashion since that deal was made. USAR, the critical minerals trades, keep those in mind, right? Whether it's USAR or UAMY, we know that the reshoring of critical minerals productions is going to be very important. So critical minerals, whether you want to play it this way with individual companies, or you want to play something like a Sprott critical minerals ETF and have a bit more diversification across copper, across lithium, across many of those different things. There's many ways of playing this, whether individually or through an ETF. And the ETFs also look very good. At least you don't have to make the decisions on individual companies yourself, right? Then the other narrative that you got to pay attention to as well is the data center connectivity plays, or basically everything that goes inside of a data center, whether it's the HVAC systems like Fix, like Comfort Systems, right? Whether it's the actual construction companies like PWR, which has been doing very well, or some of the smaller ones such as Dycom Industries. If you're looking for a smaller one, Dycom Industries, very solid. A lot of capital flows into here. Companies like LGN, which I don't even think I've ever brought this one up on the channel, but it is one that I am playing. LGN, keep those in mind, right? Or if it's the cooling solutions, liquid cooling solutions, thermal heating solutions like Vertiv Holdings, right? Whether it's Bloom Energy Corporation, right? Fuel cell conversion technology from the GE Vernova gas turbines into power generation solutions like Bloom Energy, right? So this one too, it's inside the data center, well, to be honest, the turbines are outside the actual data center, but you guys know what I mean, right? Everything that goes in either the actual companies that are doing the construction of the data centers, like we just showed, PWR, DICOM, et cetera, or things that go inside the data centers like the Vertivs of the world, or the ANETs of the world, or the Credos of the world, or the Celesticas of the world, right? All very popular names. So pay attention to all those as well, right? So we've just highlighted a bunch of themes that people should be paying attention to over and above the expansion of, the consumer staples trades and, just broadly speaking, the rotation towards dividends and defenses. You can see SCHD, clear outperformance here since the beginning of the year. This was a very good buy from us to start off the year, obviously, right? But if you're looking for key niche themes to find momentum that are not boring, value-oriented companies like Colgate-Palmolive or Procter & Gamble or Kimberly-Clark, right? If you're looking for the momentum sectors that are still finding a lot of inflows, pay attention to all those key themes that we've just highlighted, right? The critical minerals, the energy components, the data center connectivity plays, aerospace, military defense, drones, robotics, things of that nature, right? 4 key sectors that we highlighted a lot during the month of January, but I'm just here to tell you guys that these sectors are still going to be where a lot of the capital will be flowing, and not just for the next few days and weeks, guys. Like, these trades are underway for, the next few quarters, arguably the next few years as well. Not all at once. There will be some pullbacks here and there, but they will be very, very popular key themes to pay attention to and can lead to some outperformance if we are patiently waiting for some of the dips on them, right? Like AVAV. We can't say that these never pull back. They do often offer some pullback activities, right? And names inside the data centers with some bottlenecks, as we highlighted earlier, right? SanDisk or Micron, if you're looking for if you're looking for a big growth, right, or you're looking for bottlenecks, right, they're giving you tradable lows. Just wait for them to set the tradable lows on Micron for some expansion, tradable lows on SanDisk for some expansion as well, right? Just tightening up here, looks like a bull flag, go for some expansion. If they ever wind you down, at least you have a stop loss and you can maybe look for reset lower with some weekly consolidation at the 12 EMA. Very simple, right? There's no reason not to play these. It's just you have to be a little bit smart in how you play them, because the rallies are violent, but the pullbacks can also be violent. And just for example, right, back here, this pullback in November, perfectly back tested almost the 12 EMA. That was a 35% pullback from the top, right? So we can't say that it can't happen. It can definitely happen as long as you're ready for it and know what to look out for. And you want to play momentum? Well, you're going to be set up with the best odds, to possibly play these. So that's everything that I had for you guys today. Since I won't be seeing you for the next few days, I figured I should just throw everything at you at once, and that way you guys have the full weekend to research some plays if you were looking to play some of these sectors with a portion of your capital or whatnot. The moral of the story, guys, is there's something for everybody in this market. Whether you want to buy the dips on Mag 7 names, right? Whether you want to buy the dips on other large cap growth names such as AppLovin or Reddit, or Axon, or Shopify, which we've been bringing up recently, that have been wildly out of favor. Whether you want to try your hand at playing a software mean reversion trade with IGV or certain names individually, like ServiceNow or Intuit, if you feel so compelled to do so, or if you just want to avoid all those sectors that have been out of favor and concentrate on the sectors that have been in favor recently, such as the ones we highlighted at the end of the video today. Or if you just want to focus on building out the dividend portions of your portfolios, because we have some nice rotations back into the defensive aspects of the market, and there's still very many dividend names out there that are providing very good yields and that are still at relative lows, right? If that's the type of investor that you are, whether it's locking in the yields on UPS or locking in some remaining yields on Pepsi on some consolidations, right, offering some pretty good dividend yields, or whether it's like Kimberly-Clark down here at the lows offering a 4.66% dividend yield. There's so many things. There's something for everybody in this market, something for all investors. The one thing you just don't want to do is run around like a chicken with your head cut off, right? Have a plan. It's okay to play many of these different things at the same time. You can be buying large cap growth, high quality compounding companies with a portion of your portfolio, but then say, you know what, with like 10, 15, 20% of my portfolio, I want to play the themes that are in favor. I want to play aerospace and defense with a bit. I want to play energy. I want to play critical minerals, right? and derive a plan as to how you're going to allocate the capital to play those, right? Derive a plan, derive a thesis, derive some potential take profit levels where when they get achieved, you're going to be happy and you're going to pull money out of there and possibly rotate it into some legacy names that you've always held in your portfolios, right? So there's many ways to play this market, guys. You can't say that there's nothing to do in this market or the market overall is just bad. If you are of that opinion that the market is just bad and you're just staying away, I mean, you gotta level it up. You know what I mean? You got to look deeper into things. There's always money to be made in all markets. We can't just paint the markets with a broad stroke and say, oh, the markets recently have just been all bad, or they've been all trash, or certain companies that ran a lot are just wildly overvalued. I don't want to play those. You kind of got to follow where the money is going, right? So there's something to do for everybody, whether you're part of the buy the dip crew with a lot of legacy compounding companies, or whether you're a momentum trader, right? Trading a lot of the hot topics and hot niches. There's something for everybody in this market. So you got to get used to the volatility. You got to get used to the rotations. It's a critical component of, somebody who's going to become a very good trader or a very good long-term investor, right, is identifying these key themes and narratives and positioning in them. And there's always a way to manage the risk, right? Maybe you want to play SanDisk and Micron, but you're just scared because they ran so much. Well, there's a way to do it, right? It just means that you're just going to take a lighter position overall. It doesn't mean you don't have to play them. It just means you play them at reduced size, something that you're comfortable with, right? Everybody has different goals, different tolerances, right? So keep all of that in mind, different preferences as well. But that's it for me, guys. That's all I had for you guys today. So hopefully you enjoyed the video. We covered a lot of things today, and hopefully it's going to help you out for a bit of a deep dive on your own for what you want to do with your portfolio as we come into the end of the month of February. So thanks very much for watching, guys. Hope you enjoyed it. If you did, you know what to do. Consider dropping a like. Helps me grow the channel a lot. Consider subscribing to the channel if you're new as well. I would love to have you back. And last but not least, if you have any questions or comments or stocks that you wanted to share with the chat, or sectors that you wanted to share with the chat in the comment section down below. I love hearing from you guys. You guys always bring very good ideas to the discussions, so leave them down below. That's it for me. Have a beautiful weekend, guys. Take care, and I'll see you next week in the markets. Peace.